Welcome to slide pack 4 of the financial modeling program, where we will talk about discounted cash flow valuation. Now, there are many ways to value a company, and each approach has its own merits and drawbacks. Discounted cash flow is another valuation method, and it's a fairly good one because what it does is it discounts cash flows that are expected to be generated by the company's routine operations in the future. So where a company is expected to continue operating for the foreseeable future, DCF is definitely a good approach to valuation. On the flip side, if a company is planning on winding down, then its future cash flows essentially almost do not exist, and so DCF in that situation would not make sense. And the basic concept is, what would you be willing to pay today for a set of future cash flows, where those cash flows are really best estimates on what you or the financial modeler thinks is going to happen with the company in the future, in the business environment that it operates in. And so, again, because of the uncertainty with future cash flows, you have to apply a discount rate to factor in the various risks to get the present value of future cash flows. This present value is also called enterprise value. Now, when you take this present value and you throw in whatever cash the company has, and then you pay off the debt, what is left is money for the equity or the shareholders in the company. So first, specifically, let's figure out what cash flows need to be discounted. These are the cash flows after tax that would be available to pay off debt and all other liabilities and essentially have something left over for the equity holders. So in arriving at the cash flows, the first step that you need to do is project out your income statement, your balance sheet, and your statement of cash flows. Make sure they balance. And then go back to your income statement and look at your estimates for the earnings before interest and taxes. This is your EBIT. On this EBIT, calculate the corporate tax liability that you'd have to pay to the government and subtract taxes from EBIT, because taxes have to be paid. So take them out of the equation. Once you've taken taxes and subtracted them from the EBIT, add back depreciation and amortization, because these are expenses that did not actually impact the amount of cash that you have in the company. Next, as step 4, subtract out routine maintenance related capital expenses that the company normally incurs in its operations. Now here we are only talking about routine expenses. We are not talking about capital expenses where the company is planning a new plant or is planning something that is for expansion. Focus only on the capital expenses required to maintain the scope of operations as they exist today. Now, there are other non-cash line items, such as changes in working capital, that you might want to consider in valuing your stream of free cash flows. But on that, those tend to be company specific. So our advice to you is sit down with the accountant and figure out what is realistic in terms of calculating unlevered free cash flows. Unlevered means free cash flows without interest payments on debt. What you get after step 4 is the free cash flow for each period, and this is the number that you will be discounting. Now, there's something called terminal value, and here's what it's all about. A financial modeler typically projects out to 3 years, sometimes 5 years, but not beyond. But a company like a Microsoft or a Google or an Apple or an Exxon or a Walmart is likely going to continue to operate for several decades. And so counting only 5 years for free cash flow would grossly undervalue this company. That said, projecting out 20, 30, 40, 50 years is not realistic either. Who knows what's going to happen 30 years from now or 20 years from now or even 2 years from now? So beyond 5 years, the rule of thumb is that you assign what's called a terminal value for the future cash flows that the company is expected to generate beyond your 5-year projection period. Now, terminal value is not very easy to compute, but there are some approaches that have been developed. One is to assume that whatever your free cash flow is on your 5th year of projections, assume that the company is going to not grow beyond that and is just going to carry that level of free cash flows in perpetuity. So then the way you'd value that is you'd take the 5th year free cash flow and simply divide it by the discount rate that you're using in your NPV model, and that is your terminal value. Or what you can do is you can apply an exit multiple. You can look at comparable publicly traded companies and look at how they are valued as a multiple of revenue. So a company could be 1.2 times revenue or 0.5 times revenue or 2 times revenue, or a multiple of EBIT. So a company could be valued at 8 times its EBIT or a multiple of EBITDA. Now, all of these multiples, broadly speaking, should ultimately converge to roughly the same dollar amount. So this is how you'd calculate terminal value. Now, so now we know that there are free cash flows generated for the 5 years that you're projecting, and there's the terminal value. What you now need to do is discount the free cash flows and the terminal value back to your valuation date of today. And you do that using the NPV formula that we spoke about earlier. And for that, you need to calculate your discount rate. Now, when you value companies, the discount rate is calculated as the weighted average cost of capital, or WACC, W-A-C-C, WACC. It's essentially the cost of equity capital multiplied by the equity percent in the company plus the cost of debt capital multiplied by the percentage of debt in the company, and we will get into details on that. So the cost of equity calculation is not a simple, straightforward calculation. A formula that is commonly accepted in financial circles is that the cost of equity, which is RE in this slide, is the risk-free rate that you'd earn if you put your money in a 10-year treasury bond, which again is sort of a standard 10-year rate that's used, which assumes that the US government's going to pay off its liabilities, and so what you have in that investment is relatively risk-free. So you start out with a baseline risk-free rate. You add the product of something that's called beta multiplied by the risk premium. Now, beta measures the risk of your company relative to the broad market. A lot of large companies tend to perform about the same as the broad market. So if the market goes up, their shares will rise proportionately. If the market goes down 10%, their shares will go down, maybe 9%, maybe 8%, maybe 11%, but more or less in sync with the market's performance. But you may have growth companies, or you may have laggard companies. So a growth company, when the market goes up because of bullishness on its growth, a growth company where the market gains 10%, the growth company might gain 20%. In that case, you'd say that the beta for the growth company is 2. On the flip side, you may have a company that reacts opposite to the market reaction. So if the market goes up 10%, this company might go down 20%. So in that case, it would have a beta of -2. And betas are calculated by companies that observe market movements over long periods of time and tracks individual stock performances relative to the market and come up with an average beta. So if you search online, you should be able to get beta estimates, if not for your company, then for companies that are similar to your companies. And what you'd have to do is then apply your own intelligence and common sense and tweak the beta such that you and your management and your stakeholders believe that that beta accurately represents a measure of risk of your company relative to the broad market. So the beta is multiplied by something called the risk premium. Now, I'll explain this with an example. A large company is at less risk of generating free cash flow than a small company. And there are other factors such as liquidity, etc., that get factored into risk premium. So your cost of equity is your risk-free rate plus the beta multiplied by the risk premium. Cost of debt is slightly more straightforward because typically when you enter into a borrowing, you know what the rate of interest is that you have to pay. So if you have, let's say, 3 series of debts, one could be a 10% debt, the other one could be a 3% debt for maybe a different amount, and the third one could be, say, a 7% debt on a different amount with different maturity. So what you have to take here is the weighted average interest rate on all your borrowings. Now, the equity percent is the total amount of equity capital divided by the total capital, where the total capital is the sum of the equity capital and the debt capital that has come into the company. Likewise, the debt percent is the debt capital divided by the total capital. So just coming back to the weighted average cost of capital formula, it's the cost of equity times the equity percent plus the cost of debt times the debt percent. Now, we spoke about mid-period discounting before, and to briefly recap, your projections happen at the end of the year, but your business operates through the year and generates profits through the year. So a lot of business managers prefer assuming that the cash flows occur as one slug at the middle of each year. So the discount factors tend to be to the power of 0.5 for half a year, 1.5 for a year and a half, and so on. But do note that the terminal value is not subject to mid-period accounting. The terminal value happens at the end of 5 years or at the end of your period of projections. So what you'd apply in terms of a discount factor to the terminal value is, in the denominator, it's 1 plus the weighted average cost of capital raised to the power of 5 in our example. Once you add cash flow 1, the discounted values of cash flows 1, 2, 3, 4, 5, and the terminal value, and sum them up, you get the enterprise value for the company that you're working on. Which, like we said, enterprise value plus cash minus debt is the equity value, which is a proxy for the market capitalization of the company. And the equity value divided by the total number of shares outstanding gives you the DCF, price per share. Now here, let's just briefly go over how you can take data from Excel and cut and paste it into your PowerPoint presentation. So what I plan to do here is I am going to go into Excel and I will select a range, and I simply press Control C to copy that range, and then I go back to my PowerPoint and make sure that my cursor is on my PowerPoint, and then I go into Edit, Paste Special, and here I paste it as a picture enhanced meta file, and I say OK, and voila, that's the Excel data that's now a part of my PowerPoint. Likewise, I can take a graph in Excel and paste it into my PowerPoint. Now, a lot of times you may say perhaps not need all of the columns that are there in Excel. So what you can do is you can, let's just say, hide fiscal year 2006 and 2007 in Excel using a column hide formula, and then go back and then again copy data. Go to your PowerPoint, delete what you had before, and go back to Edit, Paste Special, Enhanced Meta File, and there you've got the new data. And Excel is very good in this format about not displaying the hidden columns. So this is just a very quick and easy way of showing you how you can take information from Excel and paste it into your PowerPoint. So this concludes slide pack 4, and thank you for your time and good luck with developing your financial models.